Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. Welcome to another one of these informal type videos helping you understand what's going on with the market today and maybe take advantage of some of these lower prices. And actually we're going to be combining this video with our monthly dividend stock series. Okay, for those of you that don't know, we started January picking 3 dividend stocks each month to put into our M1 portfolio. We did the same thing last year with 10 stocks, actually beat the market with a 31% return. And we're putting these stocks, as I said, into an M1 finance account. We started the year with $1,200. And I love the portfolio view on M1 finance, right? You decide what kind of percentage you want in each stock or each fund, and then the site is automatically going to reinvest your money across that portfolio. It's going to let you rebalance it. It's just an easy way to hold a group of stocks and reinvest in each. You can also reinvest all your dividends. You reinvest your cash automatically. So it's a great platform to use. So we're in our 4th month of the 2020 Dividend Stock Challenge, and the market has obliterated our dividend picks. And it's clearer than ever that you need safe dividend ETFs in your portfolio. Okay, our portfolio is down 15% so far over the last month versus a 19% market loss. So it's actually beating the market, but there are some big losers here. We've got some winners as well. So I'm holding the excess cash in that bond fund, in the BSV short-term bond fund. That's up over 1% over the last month. Kimberly-Clark, Gilead Sciences, Pepsi, WestRock, Dominion Energy are actually all beating the market, but we've got those huge losers here. Carnival Cruise Line, ticker CCL, is down 55%. The AMLP, the Alarian MLP fund, is down 52%. So what we're going to do today is we're going to look for some dividend exchange traded funds. These are funds that hold groups of stocks, and we're going to be concentrating on dividend funds. And we want to add those dividend ETFs, those exchange traded funds, to get that safety from headline risks in any one individual company, right? So obviously if you've got a dividend fund of 50 stocks, then that's going to be much less exposed to the fraud or poor earnings that you get in any one individual company. One stock, one company within that fund might do poorly, but it's not going to drag the entire fund down and lose a lot of your money all at once. Okay, so you get this safe income, this safety play and diversification, plus it's going to free up a lot of time to analyze just a few more stocks for your portfolio. Now, this is a very important strategy I use called the core satellite strategy, where you invest the majority of your money in maybe 3 to 5 ETFs, 3 to 5 exchange traded funds. That's going to give you a market return and income and safety across a group of assets and themes. And then you use your extra time, you use your free time that you get from just investing the majority of your money across that group of funds, use that to pick maybe 8 to 10 individual stocks. That's going to free up your time to really dig into those financial statements and analyze those 8 to 10 individual stocks to make sure you're getting the very best of the best. Okay, and it's not just dividend stocks though, some great income opportunities in these funds. This is another reason why I like ETFs and these funds, is that it gives you exposure to assets that you wouldn't normally get, like maybe preferred shares, some bonds, commodities, and real estate. And why this is going to be important here is because it's just going to diversify our portfolio out a little bit more into different income investments. That's going to not only help us protect us from this further stock market crash if it does come along, but it's going to give us exposure to those other assets. It's going to give us more income than we would normally get just from stocks. So I want to cover 4 factors that I look at when picking an ETF, when I want to find the best ETFs to add to the portfolio before we get to those 5 exchange traded funds that I'm adding to the portfolio in April. And first, it's just the expenses, right? You've got to look at that expense ratio. Now, this is a percentage of the fund assets that the manager takes out each year to cover those management costs. And this can be the biggest drag on your funds and on your performance, okay? Some of the highest paying funds, this is something you really have to look out for, because some of the highest yielding funds, so those highest dividend yields, are also some of the most expensive. You get fund managers like Global X and Invesco have very high fees and it might not necessarily automatically disqualify those from the funds that you actually invest in, but it's a big factor you have to look at. Okay, if a fund is charging 1% each year on your assets versus maybe a Vanguard fund that's only charging 0.1%, So you're paying 10 times more just to hold that fund than you were with this other ETF. So definitely look at the funds. You can usually find a comparable fund or a similar fund that invests in the same theme for lower expenses. Another factor here is, does it fit with your portfolio? Okay, are there sectors in the economy or themes that you need to round out your other stocks and funds and your other ETFs? Okay, you might have a technology fund, a technology stock fund. Well, it wouldn't make much sense to buy maybe another a market fund, which happens to have about a quarter of its fund assets in technology, because you're going to get a lot of duplication there. So what you want to do is you want to look at your portfolio as it is right now, find the gaps, find the holes in it. Okay, so what sectors of the economy? That's utilities, staples, technology, financials, things like that. Or what themes are you missing out on your current portfolio, and maybe add some funds to fit with that. You also want to look at the overall return. Okay, I know a lot of investors look at these funds and even individual stocks, and they chase that dividend yield. Okay, they look to see which which funds and which stocks have the highest dividend yield. They invest blindly in those, and they pay no attention to overall return, which is very important. Okay, especially with these high dividend yield stocks and funds. That maybe that's your only return, or maybe the price return on the stock or the fund is actually negative, so it's actually detracting from some of that yield. So you definitely have to look at the overall return on these funds before you jump into them. So just look to see, pull up a chart of the fund and look to see how it's done versus the S&P 500 over that year or 2 years or longer. So now let's get into those 5 dividend ETFs that I'm buying in April. 5 great picks for income, not only in stocks, but from a lot of these different assets and themes that can really diversify your stock portfolio. These are going to be high yield, safety funds with different assets for more protection from that market crisis. And first, we're starting off with the Invesco S&P High Dividend Low Volatility ETF. That's ticker SPHD. Now, this one follows the market really closely and has had a 31% loss year to date, but it's really bounced off those lows and has a much higher dividend versus the S&P 500. The dividend yield here is 4.8%, so it's more than twice the 2% yield on the S&P 500 on that market index. It does have a higher exposure to safety and income sectors like real estate, utilities, and staples. So I like this one for a good overall diversified fund for the stock market. If you were to invest in just the market fund, say the S&P 500 ETF, which is ticker SPY, you'd end up actually getting a lot of your money in some very cyclical industries or very cyclical sectors like technology and financials. When you buy a low volatility fund like this, like the SPHD, you're actually getting a little bit lower volatility, a little bit counter-cyclical sectors, as well as that dividend yield. Now, this one trades for a 15.6 times PE ratio on about 50 stocks. So a little bit expensive, really right around that market valuation. It does charge a 0.3% expense ratio, so a little bit higher than some of the other funds we'll look at, but still not the highest that you'll find. I really like this next one for a good overall fund for stocks and bonds and those multi-asset ideas, and that's the iShares Morningstar Multi-Asset Income ETF, or ticker IYLD. Now, this is an income fund with exposure to stocks and bonds and a lot of other assets. It's down 21% year to date, so outperforming stocks and really safety in those non-stock assets. Okay, where you see that outperformance right now is in the percentage of the fund that's in bonds and those other assets that are really protecting you from the stock market crash. Now, this one pays a 5.1% dividend yield, though the expense ratio of 0.6% is really high. It's about as high as I think I would pay. I'd never pay more than about 0.6% on any fund, because like I said, you can usually find a similar fund that invests in similar assets and a similar theme for a lower expense ratio. Now, this one is different from other ETFs that you'll find, which actually own the stocks and the bonds themselves. Okay, most ETFs will directly hold the shares of the companies or the actual bonds in those themes. This one is more of a fund of funds. Okay, so this one holds other ETFs for exposure in those asset classes. So you'll see here, this one owns shares of the iShares iBoxx High Yield Corporate Bond Fund, for example. It owns 22% of the fund is in that other fund. It also owns shares of the Emerging Markets Dividend Fund, ticker DVYE. So what you're going to get here is a lot of other funds that invest in other themes and other assets all put together into this one all-in-one fund. Now, most of these are really good individual choices if you want to scroll through here and just pick them separately. I am a little bit worried right now about the mortgage market and some of these mortgage funds, but the rest of these you can actually pick individually and kind of create your own fund of funds as well. Our next fund holds one of my favorite assets right now, that's preferred shares, and the fund we're adding is the Global X US Preferred ETF, that's ticker PFFD. Preferred stocks are like a mix of bonds and stocks. Okay, they pay out dividends before stock owners, and the ownership can be convertible into shares sometimes. Now, the Global X Fund is actually down 15% year to date. So again, beating that market by more than 10%, and it pays a 5.7% dividend yield, and actually is a pretty low expense ratio at just 0.23%. Now, this is heavily weighted towards financial companies because those companies are just ones that tend to issue more preferred shares. Okay, so a company can issue regular shares, so equity. They can issue preferred shares, which are that mix between bonds and equity, or they can issue bonds for payment. And the financial companies just happen to do that more often than others. So you've got companies like Wells Fargo, Bank of America. Now, preferred shares will tend to underperform the market when the stock market is rising quickly, but this is an excellent fund for safety, yield, and some return upside as well. Probably my favorite bond fund here is the Vanguard Long-Term Bond Fund, that's ticker BLV. And it's times like this last month that it becomes obvious how much you need bonds in a portfolio, and this is one of my favorite ones. Okay, this bond fund holds over 2,000 bonds with just under half in U.S. government debt, and the rest are all in that high-grade quality corporate debt market. These are all financially strong companies, very strong balance sheets, and are going to be surviving through this crisis. Now, this fund is up 6% year to date, along with that 3.1% dividend yield, and it's got a rock bottom expense ratio of just 0.07%. So I'm buying this one not just for the yield, but safety and that upside return. Okay, so holding bond funds also gives you that opportunity to take advantage of these lower stock prices when you want to buy in. Okay, so we're investing in this BLV right now, but in a couple of months, if I think maybe the stock market has definitely bottomed out and is on the way higher, then I can sell some of this bond fund that has provided that cash return, the upside potential, and I can invest in those lower share prices. So our fifth fund here is the Vanguard Real Estate ETF, ticker VNQ. Everyone here in the nation knows I love real estate, and it's another great asset class to have when the stock market gets crushed. Okay, the fund holds shares of 184 real estate investment trusts, that's REITs, that actually themselves own real estate and then pass those dividends on to investors. This one is fairly well diversified, so you get that exposure to all the different property types with just this one fund. Now, what you can also do, though, is to try putting together your own fund with individual REITs in some of these property types like healthcare, industrials, and those specialized REITs like data centers. I'll actually be doing a best REIT stocks to invest in about a week here. Take a look at that, because this VNQ does actually hold some of those poor, weaker sectors like retail, like mortgage REITs, things like that you might actually not want to hold. So the fund is down 24% so far this year and provides a 3.6% dividend yield with an expense ratio of just 0.12. Now, this fund is down 24% so far this year and provides a 3.6% dividend yield with an expense ratio of just 0.12%. So a solid yield with a low expense ratio, really two of the things that you really want to look for in funds. It's not So the fund is down 24% so far this year, and now the fund is down 24% so far this year, but So the fund is down 24% so far this year, but it provides a 3.6% dividend yield and an expense ratio of just 0.12%. So solid yield, low expenses, two great factors when you're looking for the ETFs that you want to invest in. This isn't quite the protection of a bond fund, but it's still a great asset class and a really strong dividend yield for your portfolio. Click on the video to the right for the 5 tech stocks that I'm buying that could actually benefit from the crash for huge returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.